What's happening, gentlemen? Good to see you.
Good morning from the West Coast.
Yeah. Look at this. Three very passionate mortgage guys, all extremely handsome. In particular, Brad Blumberg from Astor Key. We got Kobe Hackalier, T360, Greg Scher from NFM Lending. What do we have up on our screen right now? What does this look like to you guys? Kobe, this is the first time you've seen this. What do you see when you look at this?
I'm seeing massive discrepancies in data. I'm seeing massive discrepancies in scoring. If I'm a lender, am I better off seeing all three of these or one of these? I don't even know. What would you do with this?
Well, I'll tell you what. Let's suppose, Brad, that the Mortgage Bankers Association, they're able to push through their single pool edict. And this is the new world we live in. So if you have a score above 700, maybe 720, because I hear it might land there, you are in business under this new proposal. You got a 734 score, and guess what? You're going to get among the absolute best rates with roughly the least amount of risk you can get, certainly relative to somebody with those other scores. So you get a 734 score. You get today's fixed 30-year rate of, call it 6%. Sets off a chain reaction. You close the loan. Loan gets sent to Fannie Mae. Fannie Mae assumes this is a great loan, 734. That's a pretty good loan. Let's say Freedom buys the servicing, even though it's a conventional loan. They don't buy a ton of that. Or let's call it PennyMac. They buy the loan. They're booking this loan for, 3 to 5 years in payments. They got a good low rate. Their economists project that rates aren't going to go into an area over the next 60 months where a refi is even possible. So they are booking that income. Do you think, Brad, they'd want to know that underneath this hood, if they had dug a little bit deeper, you think they'd want to know that this borrower isn't exactly who they thought they were? And let me show you why. This is the same consumer. This consumer who's got that 734 in the last 12 months, in the last 7 months, they've got a 30-day late, they have a 60-day late, and their balance on this revolving debt is pushing right up against the limit. None of that's good. Right below it on a Citi account, they've got a payment. They were 30 days late in January. I guess we can look past that, right? That's on a small level. So this is that same consumer. And so you have TransUnion and Equifax picking this up, but you don't have the other one picking it up. And under the MBA's new proposal, if you pick up the 734, you're in pretty good shape. So, Brad, I know you have researched the credit game, to a very deep extent. What do you think of this? What do you make of it? What do you think of this scenario?
I think it's an architecture problem. I mean, right now you do have three separate scores. So this moment in time, you have an non-competitive industry where you're going to buy the three scores because you don't want to have that problem. So I think you have to take it back a step and start thinking about, if you did go to one score, how would you do that? How do you pick up these other things? And there's a quote. You ever hear Charlie Munger? He was Warren Buffett's partner.
Yeah, Buffett's his late right-hand man.
So he had a famous quote: "Show me the incentive and I'll show you the outcome." So there's not a lot of incentive here for everybody to pick up the score. I've never seen a public rating that says, hey, Experian gets it right 75% of the time. TransUnion's number 2, Equifax is number 3. I don't see anything competitive or anything that would make anyone really have to figure out, my score needs to be the best. And as long as you have to buy three scores, like we said, takes 3 credit bureaus to screw in one light bulb to kind of get a picture, I think you're not going to solve the problem. So
No,
think
but
you have
just
to think
focusing
about
on this
ways.
particular thing, are you in favor of a single pool as it is constituted now, the way the bureaus are set up? Looking at this scenario, would you want this loan? Is this a loan that you would love to take on your books and book the servicing and all that, thinking it's a 734 FICO?
If I had other ways to verify the score, if I was pulling in other bank statement data and I could underwrite it, maybe I would, but I'd rather see a more rational way to say, hey, year one, somebody in government or industry is going to start seeing what's in these scores, who has better scores. Year two, we're going to go to whoever's the best. You have to take the best plus another one. And in year three, we're going to go to one score. So I think if you kind of phased it in a way that you could get to one score because you're going to open it up to other scores and other models and someone's going to benchmark it, I think you'll get there.
Sounds like a lot of work, man.
Yeah.
Sounds like a lot of work. I mean, all of a sudden now you got to do even more research. You got to look at more bank statements and things to try and come up with all of the details here. Kobe, you've been pushing back on me a little bit on this. What is your position on this?
Yeah, my position is we can go on with the status quo forever. But before I get into that, I mean, Equifax and TransUnion, in the example you just showed us, they've got the same data and they're 82 points apart. The difference between what a borrower can get on the market on a 662 versus a 580 are worlds apart. So even with the same data, we still have a scoring issue. The answer is not to say, hey, we've got such a divergence of scoring and divergence of data that we need to keep all three of these in place. The question we should be asking is, what pressures can we implement? What levers can we pull as an industry to force these credit bureaus to produce better data and more consistent scoring out of that data so that we can rely on it, like all the other industries that rely on a single credit pull? I spoke to a loan officer this morning who responded to the post that I made, and he said, hey, I've been using free annual credit report with my customers as a way to kind of save them money and do pre-approvals or pre-quals. I guess he's doing pre-quals. And I said, well, that data is coming from the bureaus, but which bureau are you asking them to select? Because you can only select one with the free annual credit report. And he's only selecting one because he feels that one's the best. I don't remember if it was Experian or Equifax, it was one of those two. But we have a problem in that we've got FHFA mandates in place that require us to do things the way we're doing them now. It's antiquated. It doesn't make sense. It's allowing these bureaus to price gouge. We need answers in place. And yes, that's going to come, to Brad's point, with a little bit of risk and a little bit of pain, but that's the only way to get to the other side of this. Otherwise, we're stuck in the same paradigm forever.
Well, why aren't we just going after the perpetrators here? Why is there nothing that the government can do to crack down on the abusive credit practices of FICO and the three bureaus?
I mean, do you want to put government price controls in place?
I don't know if that helps consumers get, be able to get into homes and make home ownership more affordable and stop this madness. Absolutely. Yeah, I do.
Yeah. I mean,
if the alternative is this, if the alternative is taking a picture that looks pretty good, if you pulled Experian and putting them into this house only to find out 4 months later that there was a trend we didn't see and the borrower ends up defaulting, and suddenly the default rates go up even a smidge, even 0.5% or 1%. And then all of a sudden, guess what happens? Fannie puts in higher LLPAs. The secondary market suddenly prices in more risk because of the uncertainty. And guess who pays for that, Brad? Take a guess.
Not me. I'm over 800. So
yeah. The consumer pays for that.
I mean, look, when you have the government involved, the government is not always a bad thing to have involved, right? But there's certain levers that the government pulls that are detrimental to the consumer in terms of unintended consequences, and there are certain levels that are helpful to the consumer. If you look at what the government did when it broke apart Ma Bell, right? I mean, that introduced tons of competition into the market. Long distance calling rates went, basically to zero, right? It changed the entire landscape of this country when everyone thought, okay, well, this is how we're doing it. We need to keep doing it. When you have the government come in and institute price controlling that diminishes the quality of the product because that diminishes the incentive, right? And as to Brad's point, show me the incentive and I'll show you the outcome. The reason that they have no incentive now to improve their data is because on the incentive isn't there for them to do that. So they can continue to raise their prices and continue to ingest the data they're ingesting and then produce white papers that they put on nationalmortgagenews.com that tell us why the industry needs 3 bureaus, because otherwise you're not looking at a person as a whole person. I mean, that was something they paid somebody with an MBA to do, to basically promote the idea that, hey, we're so incompetent, each of us on our own, that you need all 3 of us. What they're doing is blatantly protecting the oligopoly that they've been allowed to form. And if we sit back and say, well, that's the only way to do it because we can't think of a better idea, well, that's a failure on us.
Is this a good idea? Is the Singer pool a good idea that you both support?
Yes, I support it 100%. I don't support moving there at the flick of a light switch and saying, well, that's what we're doing starting tomorrow. But, I think we need some kind of phased plan. I think we need to put pressure on these bureaus. And if we do, you'll start to see that the data looks a lot closer than it ever has.
Yeah. And what's going to prevent them from just raising their prices if we go to this model? You just said that it's out of control and that nobody can really get a handle on that. So, okay, all of a sudden we need single pools, and let's say that their revenue drops by 35%, 40%. What's going to stop them? How are we addressing the problem? What's going to stop TransUnion in that scenario from raising their scores a third or 2/3?
You have to let a little more competition. Look, I've seen some of the Plaid models. Plaid has a score 1 to 100. They're starting to take in some data because of open banking. So I think what you need to do, you need to allow a type of open banking Plaid model to come into the credit scoring. And so I think if you did a couple things at the same time, over 1, 2, 3 years, move to let one score, but you can still buy 3 scores. So just open it up a little bit, and let NFM's going to do whatever and wants to do to kind of make sure that they're not buying back loans and having default. And some people may be a little more aggressive and do some other underwriting, but let other people in, and it has to be GSE and Wall Street kind of have to come along with it a little bit. But if you had other models and other score models and other type of CRA things coming in, you just got to open, as Kobe said, a little deregulation, a little more study. I mean, I pulled some studies I sent you guys this morning. I mean, there isn't a lot of studies on, they're all doing something different. So TransUnion may not post a foreclosure in 90 days, but Experian may. So they all are pulling data and posting things in different ways. And there's a lot of new models like buy now, pay later. You don't even see unless you're looking at a credit card.
That's a good point. I mean, that's another problem. It's another problem. But in essence, the inefficiencies that have been built among the 3 bureaus have necessitated that they need all 3 of you. They need all 3.
Yeah, it's the greatest 3-card Monte game in the history of this country. I mean, that's really what it is. They are purposefully playing, hide the foreclosure.
Yeah, they love this. They love this graphic here. They're eating this up.
I'm sure they do.
Do you think they do? I mean,
Owen Bordini doesn't.
Yeah, that's funny.
Yeah, Brad, why don't you think they like it? Yeah, why don't you think they like it? Because if they were similar, let's say all 3 scores were 734, why would we need the other 2?
I just think they're fat and happy. Like, you have to have a little edge. I think like they're Sears. Someone's going to come in like Amazon and shake it up if you let them. I just think that they're trying, but they're not top tier tech organizations. Or the fire in the belly is long gone. They kind of focused on, let's just help people know what their credit is. Let's merchants know what's going on, to how many ways can we charge for things, trigger leads. I just think it's just fat and happy. That was a good example Kobe gave, like of AT&T. It was just one big, mob organization, and not till you kind of decentralize a little till things happen. So I think that's what it needs here.
The argument that you're making to put this graphic up there I mean, this is something that if I was working for one of these bureaus and I wanted to make the case why you needed all three of us, I would use this same graphic. You're making their case for them as to, hey, they're so inefficient and they're so incomplete and they're so all over the place in terms of the scoring. I mean, the fact that two of them have the same data and are 82 points apart, that should give you pause. All of this is intended to make us reliant on their product collectively. And all of this is intended for us to be terrified of moving to any other kind of scenario. We need to take this and swat it back in their faces. If you want to talk about studies, the entities that produce the most studies around this are those three bureaus. And every one of their studies points to the fact that, hey, this is how it is. Not everybody reports to us. There's nothing we can do about it. By the way, we're raising your prices another 40% this year.
Yeah, I mean, the other thing that is at play here, and the reason why they're not going to stop is because their chips are in the middle of the table. They're all in. What I mean by that is, I mean, in order for Will Lansing to drive in the kind of profits at 33% that warrant the $65 million salary he got a few years ago, you got to keep going, man. You can't stop. There's no turning back now. And same thing with the three bureaus. Like they've been able to just continue to raise. They have a standard of living, and they're not going to stop. There's no scenario where they stop without either competition or government intervention. And speaking of competition, where the hell's VantageScore? Anybody have that answer? No, right? You're scratching your head like everybody else. I mean, who's at the controls here? The best idea we have is a single credit pool on borrowers above 700, which, by the way, Brad, tell me how that helps the 620 FHA borrower. Tell me what that does for the 660 borrower with a non-owner-occupied co-borrower. How does that help? How does that help
the low
affordability?
ones, yeah.
Huh? How does it affect affordability? Isn't that our problem? Isn't that the problem we need to be focusing on? Why are we even wasting our time up here? Brad?
Yes, the lowest non-prime see the most variance according to those studies. So you're right. The lower credit score you go, you're going to see the 50, 100 point swings, and it's less for prime borrowers. So that's the margin. The people that need it the most are in a position to get hurt the most if you pick one.
I mean, VantageScore is the love child of the three bureaus, right? I don't see how, introducing them into the mix, that produces some competition for FICO, and that's great, but that still doesn't solve the problem we have. And if you want to even take it a step further upstream, we've got an issue of the costs that are spiraling because of the credit pulls is because of repeat pulls across many different times during the transaction, the loans that don't close, the borrowers that go from one lender to another. We should also be asking, why doesn't the borrower now own their credit report? I understand why that didn't happen back in the 90s, because there may have been too much fraud introduced. Somebody may be able to manipulate their credit report. But in the digital age we live in, is that still a concern?
Borrowers should own their credit. It belongs to them. Why if I'm a consumer, should I have to pay $150 to you, Kobe, to run my credit to let me know what I qualify for? And then I gotta run up the same bill with Brad. And if you guys are close, my neighbor's telling me Bank of America's got a better rate, I run over there. I got to get my credit pulled a third time. Like, how is that efficient? How is that racket even here? Like, I believe in Europe, in some countries, you're able to permission your credit. You own it. I don't have a problem paying FICO and the three bureaus in the beginning. Here's my score. Here's my gate. I can open up the gate for you to view it, Brad, and I can close it right back up when I'm done. And we can do a refresher. I'll pay for that again in 90 days if I need to. We can rerun it again at right before we close, just to make sure nothing's materially changed. All that makes sense. Like, isn't that what we should be talking about? Making credit permissionable, open banking, essentially. This is an idea Rohit Chopra talked about at one of the MBA conferences that the Mortgage Bankers Association supported. Why aren't we talking about that? I mean, that seems like a no-brainer, clear-cut path to solving this problem. Who wants to comment on that?
Yeah, if I had a board, this is the discussion that we would have at my board meeting. You should let consumers, Kobe said in the beginning, rather than an annual one, if a consumer could grab their score at a moment in time, monthly, or whenever they wanted it, that could be used to send it to any lender, and the consumer could then right before could do another pull, or the lender should be able to get feeds directly from the bureaus and run their own scores against that. So either way would kind of open it up and reduce costs.
By the way, speaking of boards, so the NBA made a comment. One of the executives from the NBA jumped into one of my posts when I questioned this idea of a single pool. And the comment that this person made was that the decision to push the single credit pool was consensus driven, was unanimous by Resbog. And, I've talked to some people at Resbog. I know, and I know people that have talked to people at Resbog as well. I know that it's not unanimous. I know that there's a lot of questions, a lot of confusion, yet the NBA is coming out and saying, yeah, this is unanimous. Like, should these people be careful that the NBA brushes this with such a broad brush? I mean, look at these names. I'm going to try and get them all in here. I think this is what I need to do here. But I mean, just take a look. You got Serve Bank, SWBC, Lakeview, Guild, New American, PennyMac. I mean, these are who's who of mortgage executives. I mean, some really, really important voices and people. You guys recognize some of these names?
Yeah. Is your point that they're not all on board with the NBA, or are you trying to figure out why they are? Where you?
No. My point is, I know that room is not everybody's in lockstep, and there are plenty of people on that list that are asking the same questions we're asking. And my point is that it's dangerous for them. I mean, there's a couple of points. Number one, it's dangerous for them to get behind an idea that's not data driven. It seems like very emotional. Yep. I mean, I've seen CHLA. They've laid out all this data. They claim 26% of credit does not show up on a single pool. 13% doesn't report on a bi merge. You get the full picture with a tri merge. But the NBA, all they've said publicly is this is a great idea. This is used by the automobile business and other businesses. Mind you, an automobile is completely different than a house. So I think that this doesn't feel that data driven. I think there's a danger there. And I'm thinking to myself, if I'm on Resbog, would I want to have someone saying I voted for this when maybe I have questions about it? I don't know. Like, to me, it's dangerous. Like, if I can imagine at this moment, there are a handful of people or more inside of Resbog as this dust continues to get kicked up that are like, I don't want to be pulled into this. Like, I see these examples. I see a consumer with a 580 score who qualifies on a 734. I don't want that loan. Like, I just think we're at an inflection point where everyone's got to step back. This is not an attack on the NBA. I value that trade group as much as anybody. It's not what this is. This is look at how many times FHFA and Pulte have come up with an idea, thrown it out there, gotten a response, stepped back, and said, all right, maybe that wasn't the right idea. We're not focused on that anymore. We're not looking at assumable mortgages or 50-year mortgages. We're now looking at a 401k ability to withdraw. Like, why can't the NBA do the same thing?
Are you advocating the NBA act more like Bill Pulte?
No, I'm advocating that the NBA. It's funny. You're not even going to smile when you crack that joke. Come on, dude. You can't say that with a straight face unless you're trying to be a comedian. No, I'm advocating that they show the ability to pivot and take in the commentary. Like, Kobe, between our two posts and all of our interactions online, we've had well over 20,000 people in the mortgage industry look at our content, look at our opinions. We've had well over 100 state that this is not a good idea. They don't support it. That's pretty much a consensus. So it seems like there's a there to take a step back and say, wait a minute, we could point to a consensus of 46 people who may or may not even be in consensus, or I can represent the entire mortgage bankers community, hear them, and just pull back for a minute. Maybe this isn't such a good idea.
Yeah, I think I commented on your post when you first put it out there. I said, I do agree the NBA should address what the CHLA is saying. I do agree there should at least be that conversation. But I think you have to look at what the NBA's motivation is here. Are they trying to do something reckless and emotional to try to show value to their membership? Or is it their responsibility to push different ideas forward and to push innovation forward and to try to see what that looks like? And that starts with an idea. And in that sense, exactly the same thing that the administration is doing with a 50-year mortgage or portable mortgage or anything else. You're putting something out there, you're seeing how it lands, and you figure out how to maybe implement it as a tool to help affordability and help homeownership in this country. I don't have a specific problem with them coming out and advocating for it, but I do agree with you. There should be open discussion around it that includes more than just the RESBOG membership, especially if they're seeing tens of thousands of people that are passionate about it, posting about it on LinkedIn. So that's my opinion on it.
Brad? Anything
Yeah,
to
maybe
add?
a little more lender choice. So go down the road. You want to get to a 1 score over a period of time. And then lenders have choice, buy all 3. If it gets better and you're seeing more data, you go to 2, you go to 1, you let more competition in to kind of have alternate scores, see what's worked. You measure as you go, you measure defaults, and I think you kind of get to where you need to go. It's going to go that way anyway. Yeah.
Hey, look, a methodical, well-measured
Right.
course, sure. That's not what we're talking about here at this point. So, I mean, we're a $7.5 billion IMB. We are members of the Mortgage Bankers Association. We have not been asked what we think about this. I think it's pretty clear how I feel about it. I interviewed Joe Panabianco, who's the CEO and president of AnnieMac. They just closed $4.5 billion in volume. He wasn't asked. I asked him point blank. He said, nope, no one came to me. So we're the ones paying the fees. We're clients.
Yeah.
There should be no other explanation needed. Just because I'm not on a board that they would never bring me on in the first place, because I push back publicly, that means my vote's out. No,
I think
I
it's
don't
more
think
reason.
so.
I think it's more reason to bring you on. I think voices of
Yeah,
dissent
no,
are exactly what are needed.
that's not how they think. That's not how they think. Okay. And by the way, on the Pulte thing, you made a comment about Pulte. I don't mind Bill Pulte. I think his heart's in the right place. You have kicked him around publicly, Kobe. It's another thing we don't agree on.
Yeah.
I don't have any reason to believe that he doesn't want to help our business, and he doesn't want to deliver a great solution to make home ownership more affordable. He hasn't landed on the right thing yet. But let me ask you this question, and then you can comment on that, because I know you're dying to comment on that. Have you ever heard, can you recall in the 4 years that Biden was in office, and I voted for Biden, by the way, and I voted for Trump, just so you know, just to be clear. Can you remember in the 4 years them talking as much about housing and affordability and throwing out as many ideas, call them good, call them bad, as this administration has in less than a year, in all those 4 years?
By the way, Brad, did you notice he saber rattled me with a plastic fork when he started those?
Yeah, you know what? If you keep acting like this, I'll get you with 2 forks, buddy. I'll poke out both eyes.
At this point, more happens in a week than happened in a year of any other president.
I mean, if you're comparing the 2 administrations in terms of sheer volume of rhetoric, 100% this administration wins. My issue is not the ideas that come out, because I think talking about ideas is good, even if they're wild and wacky, because you can create things out of those ideas, and you can incite discussions and innovation through brainstorming. Great. My issue has been all of the things that they could be doing with a push of a button that they've neglected to do while talking about these big ideas, 0 of which they've actually actioned. That's my problem. My problem is not talking about things. It's the things that they haven't done while they're talking about things.
I got a comment here from Jameson Hawkins. Let's say you run a soft pull, all 3 bureaus for a cheap cost, no trended data to know the highest score, and then you choose to run the 1 bureau score. That can get interesting pretty fast for agencies, aggregators, and those holding the bag. I don't mind that idea.
Sorry, break that down. What he's saying, you're reading.
Well, he's basically saying everybody has to run a soft pool. Well, I guess he's making the presumption it would be cheaper, right?
Okay.
Let's just start there, because that would be the next shoe to drop, is suddenly that becomes the new normal score, right? In terms of fees. But under this premise, soft pull all 3, get to see where you are, and then you pick the highest score. But then again, that's not the idea about this, I don't think, because in the scenario we just had, what would change then? You had in this scenario right here. Okay, soft pull. We see all this. Does this loan just die here? Like, then you're talking about thresholds and how do you build it out? Interesting idea, though, James. I like it, and I appreciate your contributions, brother.
Yeah, there's a there to that idea. The big issue is we've become so reliant on the scoring model and the bureaus and the way we're doing things, and we need to see our way out of this paper bag that we've put ourselves in. And we need the administration's help. If you want me to cheer for Pulte and he does something to kind of break up the illogic of some of the policies that are in place, great. I'll be the first person to root for him. I don't have a personal vendetta against anybody. I have a personal vendetta against people that talk but don't do anything.
Well, nothing gets done in Washington, brother, without let's just use that word again, some kind of consensus. Right? Bringing this conversation all the way around. So don't make it like the head of the FHFA can go like this.
There are some things that they can enact on a policy that they can just, waive their.
Well, they're trying. They're trying. They made a commitment to buy $200 billion in bonds. They're flirting with this 401k idea, which isn't the worst of all the ideas, right? I mean, they're trying to do what they can do. In a couple of months, they'll have their own person in as the new Fed chair. I don't know. No one can press the easy button here. That's for sure.
No, you need a solution that lenders can trust, right? The lenders have to trust it. You have to get to the consumer. Can the homeowner afford this? And how you get there, there's multiple ways to get there.
Yeah, good. All right, well, this has been a good impromptu conversation. Appreciate your time, fellas. See you out there in LinkedIn land. Yeah. Have a good one.
Yeah. Take care, guys. Bye-bye.
Thank you.
And stay on here. Don't hang up yet because we got to upload the vid. All right, see ya. Bye-bye. I'm going to play an outro here. Actually, no, I'm not. I'm going to end the stream. I'm not doing any music. See ya. We'll do this again soon.